everyone. Good morning. My name is Ali Nadel, and I am at Bitwise Asset Management, which is a global crypto asset management firm with 15 billion in AUM, and I sit on our institutional partnerships and on-chain solutions team. And with me today, we have Yan-Shan Tan, head of APAC at Figment, Joseph Shalom, CEO of SharpLink, and Fisher Yu, co-founder of Babylon. It's great to be here, and we're excited to talk about institutional yield under scrutiny. Over the last couple of years, we've moved past the phase where investors are just happy to sit on spot assets. Whether you're a crypto native or coming from a more traditional background, the focus has shifted toward actually activating those holdings, finding ways to drive realized gains and generate income without blowing out the risk profile. Each of you has essentially been at the center of that movement. So to kick things off, let's do the 60-second version. Tell us what you're building and how you're helping investors squeeze out a return on their portfolios in today's market.
Sounds good. Thank you very much, Ali. My name is Yan-Shan. I'm the head of APAC at Figment. So Figment is the world's largest staking infrastructure provider with more than $17 billion worth of assets. And what we do is that we essentially provide protocol staking to the largest institutions around the world. So think of your banks, think of your ETFs, your DATs, your brokers. We work with some of the examples that we work with are like the Grayscale of the world, BlackRocks, the Robinhood. These are the institutions that we serve. And we prioritize safety, we prioritize security, and that's what really stays and really is important for these institutions. So that's how we provide the yield. And in terms of the mechanism that we provide the yield, that is protocol staking, right? So essentially, it all boils down to providing the security for the network, and in return, we generate that yield. The network provides that yield, the rewards to the investors that actually participate in the security of the network. So I guess in 60 seconds, at a high level, obviously there are more technicalities behind that, but at a high level, this is what we do and how we generate and squeeze out that return. If you put that way, squeeze out the return for the investors. Yeah.
I'm Joseph Shalom, also a happy customer. I lead SharpLink. SharpLink is the second largest corporate holder of ETH in the world. We're a digital asset treasury that started last June, listed on NASDAQ. And we've raised a little over $3 billion to buy ETH. And in some ways, if you take a step back, DATs can be very misunderstood. We're extremely focused. We are an ETH accumulation wealth vehicle. And by that, I mean, if you're interested in a highly volatile asset that's productive like ETH, you can get very simple beta exposure. But on top of that, we are going to be the best alpha overlay that you can find. Better than owning the spot, better than owning the ETF. And we're going to do that through yield strategies that are really risk managed and institutional. And we have one interesting advantage. We have a lane that doesn't exist in crypto, and that is permanent capital. When you own billions of dollars of ETH and you're putting your investors first, you can do incredibly benevolent things in the ecosystem to push the efficient frontier. And I'm looking forward to sharing some of that. But it's to the benefit of an investor, not to the management team. I think if you take a step back, we need more professionalism and we need more focus on risk management, especially if you're a fiduciary and essentially holding money on behalf of investors. That's a really big responsibility when people have entrusted you with billions of dollars to make it productive, but to make it productive in the right way. We're a steward of ETH capital.
Hello, everyone. My name is Fisher Yu. I'm the co-founder and CTO of Babylon Labs. Babylon is a Bitcoin project. Our aim is to build trustless and non-custodial infrastructures and protocols for Bitcoin to allow Bitcoin to become productive. We are most well known for our trustless Bitcoin staking protocol, which allow Bitcoin to be staked in a similar way as ETH and earn staking reward. And our protocol has processed over $10 billion worth of Bitcoin. Yeah. Then our latest protocol is called trustless Bitcoin collateral, which allow native Bitcoin to be collateralized so that it can be directly used on the on-chain finance as a collateral. For example, native Bitcoin holder can directly borrow from Aave for stable coins and use stable coins generated to acquired to generate yield. So I think the most important thing from our side is that our protocol is trustless and non-custodial and remove all intermediaries between the Bitcoin holder and the target on-chain application. Yeah, by removing all the middlemen and counterparty risks, it makes compliance and risk management and regulation much, much easier. So you don't have any fishy middlemen in the middle that work in the dark. So yeah, that's the character of Babylon project. Trustless, non-custodial, no middleman. Bitcoin does not leave your title.
Awesome. Well, great to hear those overviews. Thank you, guys. Let's dive a little bit deeper now, and let's start with you here for this one, Yanshan. Tell us what the non-negotiable criteria are for institutions before trusting a staking or yield partner in today's market.
Well, in that case, I'll start by talking about staking. What are the non-negotiable criteria for a staking partner? Since we're a staking infrastructure provider, and in all the various clients or investors that we've worked with, what I've always hear that really resonates with them is our risk framework, risk architecture, how we look at our security, how we look at the safety of the client's assets, how we look at the biggest risks that exists in staking, right? And in this case is slashing, right? Just for everyone's knowledge, what slashing is essentially if you are running the validators on the proof of stake networks, and if you act maliciously or if you act negligently, then you will be punished and capital will be burned, will be basically deleted, right, from the blockchain itself. This is the biggest risk when it comes to protocol staking, right? And for any institutional investor out there or institutional investor platform, right? For example, the DATs like yourself, like Bitwise, or any brokers that are offering this type of services, this is the most important thing to take note of, right? So the question is then, how does Figment or how does any staking provider out there minimize and reduce this slashing risk to the minimum, right? So important things to take note of are things like your incident response system, your monitoring systems. Do you have a security team that is able to monitor the uptime of your validators on a 24-hour basis? Do you have a DevOps team that is able to look at your entire tech stack and identify potential problems that are able to prop up before it actually happens? And if things actually happen, right, how do you respond to the institution's needs, right? From my experience at least, right, from the clients that I deal with, institutions, the level of requirement that institutions have when it comes to incident response, when it comes to API reporting, is on another level from what we've seen in the crypto native institutions. When we're talking about banks, when we're talking about listed institutions, even the 18th decimal point matters, right? And that's what, for perhaps the whole of the consensus week, I was up dealing with, certain ETFs with their reporting requirements, banks with the audit requirements. They can come to you to the middle of the night. Your company needs to have that capability to respond, right, to all these risk factors, basically.
I think you said it really well. We were the first public DAT in history to start staking, and it was end of May and June. And it turns out that the challenges weren't technical. I think there are a lot of really great staking providers. The challenge was regulatory and accounting. It's like super boring stuff. Who in this room knew that if you stake assets, the staking rewards show up as revenue on your balance sheet as a public company? But if you take the same billions of dollars of ETH and you put it in a liquid restaking token, in the US, it's viewed as intangible, and you don't actually get revenue, you get capital appreciation. So there's like really weird things in accounting. So we are building a portfolio, and most of our assets, we have billions of dollars in native staking, but I think the non-negotiables are different when you start trying to get yield in DeFi. So I'll give you a great example. We built a composable partnership between Consensus, Linea, EtherFi, and EigenCloud to build a liquid restaking token and to give them permanent capital. And like, what do I mean by that? We keep on saying the word permanent capital is, there's a dirty little secret in crypto that TVL is missing the L. Like, there's very little locked capital in any protocol. It's fast money, it's retail flows, it's hedge funds farming. But if you're willing to put a couple $100 million in a protocol and commit to do it for a long run, the level of diligence you require is like nothing you've seen before. You know, you're not gonna literally put it in for a month and mine. And to me, the non-negotiable is when you start going out into DeFi, most people by definition are taking protocol risk and also smart wallet risk. You're leaving your qualified custodian. You're sitting in a Web3 wallet because you want to get additional yield. You've done the diligence on the protocol, you understand the risks, but you're generally stepping out of your qualified custodians. We did this deal where we put $200 million into a liquid restaking token, but we insisted that Anchorage, who is one of our digital custodians, support the protocols natively. So imagine you can get DeFi level yields, but you're able to keep the liquid restaking token in a qualified custodian. You've just reduced ops risk. And in crypto, people don't understand that actually reducing ops risk is alpha. And when you have permanent capital, you need to think about those long-term risks. So I think what we're going to end up seeing is people do a lot of staking, start finding yield opportunities in DeFi, but allocators have a completely different level of diligence and expectation. And so we are going to start raising the standards and having higher expectations than what you've ever seen before. But in return, you get sticky capital, and we put the L back into TVL that doesn't exist today.
Awesome. Learned something new today.
Uh-oh.
Yeah. So when we talk to institutions, especially Bitcoin institutions, like the first non-negotiable is self-custodian. No one wants to lose their Bitcoin. No one wants to lose the title to their Bitcoin. No one wants any middleman between them and the yield products. So this is the first non-negotiable. Yeah. So and second is as Joseph mentioned, people are actually concerned about protocol risks and DeFi risks. So sometimes they'd rather sign some tri-party agreement to have exposure to on-chain instead of like fully utilize the on-chain products. Yeah, so counterparty risks, protocol risks, and never lose Bitcoin.
Well, great to hear your perspectives on that. So early 2026 gave us a paradoxical market. Prices faced a severe drawdown, while institutional infrastructure deployment actually accelerated. How does institutional behavior around staking and yield shift during major market downturns like the one we're currently in? And Joseph, it'd be great to start with you here.
I mean, it's a very simple answer. It doesn't. We're building a treasury that has one goal, which is to concentrate the number of ETH per share. So while the price of ETH may go up or may go down, we don't measure our success in dollar terms. We measure our success in ETH denominated. I have exactly the same number of ETH, whether the price goes up or down. Now, it means my stock is very volatile, but we own 866,000 ETH. We generate about $1 million of ETH staking rewards every week. The price is going to go up or down. Again, it doesn't matter if you have that really long-term view. That said, I think we're seeing yields are definitely driven by demand. And we've never had as much demand for staking in the history of the ecosystem, whether it's Bitcoin or Ethereum. And even if you see yields come down, all it means is that you're going to build a portfolio of different sources of yield. And when you build that portfolio of different sources of yield, there are really two ways to do it. You can do it in a way that's additive. You're just doing the same thing over and over with different sources. Or you can layer different sources of yield that are not correlated, like almost like you're building, actually exactly like you're building an efficient portfolio. And those different sources, if they're uncorrelated, won't be additive, they'll be multiplicative. And that's how you can actually generate an alpha overlay. So in some ways, it doesn't matter if the price is up, the price is down. It'll be very rocky for shareholders, But over time, if your North Star is just to continue concentrating ETH per share, you could do that in up markets or down markets.
Great. Anything to add, Yanshan or Fisher?
Well, realistically, I mean, across all the clients and investors, specifically for DATs that are, either in the ETH or Solana strategies or even Bitcoin, I do see a little bit of that shift in terms of their kind of strategy, when it comes to how they allocate the ETH to generate yield across different strategies. But ideally, it shouldn't shift, like Joseph said, right? It should maintain that investment principle, investment mindset across up or down markets and concentrate that asset per share, right? It's just that, at the end of the day, the ETH portfolio, the ETH strategies are being managed by humans, right? So it boils down to how the DAT actually focuses on the different type of strategies and how they allocate across, be it protocol staking, be it native, DeFi methods, be it, borrow lending, how and which one is the best to generate yield and the risk profile across all these strategies. What I'm seeing is that there is a slight shift towards higher alpha strategies, right? As we know, like protocol staking is much more conservative. The native protocol staking, which is what we do at Figment, is the most conservative form of generating rewards for digital assets in a DAT or in any investment, digital assets investment kind of vehicle. But as the market goes to a downturn, what I'm seeing is that, okay, how do I bring about the next narrative? How do I bring about the next story? How do I attract the next wave of investors? And even, depending on the strategy, there are some that are looking at ways to reinvigorate the interest in the stock for the short term. So what can I do there? DeFi strategies, new looping strategies. So all these could be viable, but it needs to then follow the same risk standards and framework that we have been adopting across, that are important for these institutions when it comes to the aspect of regulators or when they're attracting new investors. They need to know that there needs to be a risk framework when adopting these strategies. If that part is being able to be satisfied, then I agree that, perhaps this shift towards this new type of paradigm where we are looking for more alpha generating strategies could be viable. Yeah, but Fisher, what do you think about that?
I think you just mentioned about risk profile, right? So we think about Bitcoin and Ethereum. To me, I think Bitcoin is actually the best collateral asset in the world. ETH, to some extent, is also a very good collateral. We talk about staking. Staking is a kind of collateral. You're subject to selection risk, right? So we should expand the utility of Bitcoin and Ethereum towards collateralization-based yield opportunities. So for example, lending is one. Yeah, lending is also the foundation of the entire finance world. And then insurance, like Bitcoin-backed insurance, ETH-backed insurance, especially RWA insurance. Yeah, insurance is the second one. And then future tradings, yeah, call options, put options. So these three, I believe, are the main yield opportunities for collateral assets such as Bitcoin and Ethereum. Yeah.
Awesome.
If I can add just one more point, we are a staking provider, but we also do invest in the blockchain infrastructure itself, right? So we also run a venture capital, Figment Capital. So my personal view is that at the end of the day, how investors or DATs are able to survive across in the long term is the investment in the underlying infrastructure, right? The blockchain is built for the masses, right? At the end of the day, you need demand. You need someone to be using the use cases on ETH. You need someone to be using the use cases on Bitcoin, Babylon, the retail, the masses. That's where the value comes in. If you're focused on building the blockchain just for the blockchain itself or for the institutions, then that may not prevail in the long run. So that's what we believe in. And if the investors or the investing platforms are able to see that and take the right steps in that direction, build a narrative towards that direction, show the involvement in be it the Bitcoin, Ethereum, or Solana infrastructure, then I think that would generate a new wave of interest in the retail masses, and hopefully, right, we see increased participation going forward.
Yeah, hopefully we do. Great to hear your perspectives on the approach that institutions are taking in this market. Let's dive into the expectations for staking. How have operational risk and compliance expectations for staking evolved for institutions over the past couple years? And Fisher, let's kick it off with you for this one.
Yeah, from our side, it's quite simple. Our solution is simple enough that it does not trigger any particular regulations. Yeah, self-custodial, trustless, no middleman. So it's just as in the same way as how ETH staking or Solana staking works, which the regulators understand quite well. So from our side, the adoption doesn't have any resistance. Yeah.
Great. Anything you guys want to add?
It's very simple. I think the beautiful thing about crypto and blockchain is innovation came before rules and compliance. Right? That's great. That's actually how innovation usually works. We're at the point now where the table stakes is less around technical due diligence. There are standards, there are very high quality providers. It's very simple. Does it integrate well with my custodian? Can I get the reporting I need? And if I need to rip out billions of dollars from a staking provider in an hour, what are the handoffs and attestations I need? So we're ready to go in a downturn before others can do it. Because I want to be the first in the staking queue, and I also want to be the first if I need to in the exit queue. So I think it's no longer technical. We work primarily with delegated staking through custodians. Actually, Figure is one of the biggest staking providers under the hood. But at the end of the day, they're in a public company context. Your auditors and accountants are the ones who really need to understand what's going on. That's never been done before because it was a retail private fund play. And so it sounds really boring, but you have to build the controls to be able to monitor this stuff. And in a tail event, you want to be the first out and you want to be very efficient. And that's what we're going to do.
Yeah, totally. I just want to add to this. It's no longer about the staking or whatever technology itself. It's once you use that technology and start to generate capital gain or yield, what the accounting side looks like, the tax side looks like. That is the more complicated and challenging ones.
Yeah. So exactly, right. As the service provider, the staking provider, finality provider, right, on your networks, that's exactly what I see, right. And the 18th decimal point for the valuation of that ETH to mark to market, that's not a joke, right? I really see that in my day-to-day operations. And in terms of what I see that has been evolved, right, in terms of operational risk framework, compliance structures, is that in the past few years that I've been at Figment and the evolving type of client base that I work with, right, I'm seeing that there's a shift of mentality in terms of how they approach the importance of risk, the importance of security, right? If you were to ask, some of my client base or investors in Ethereum or Solana or Bitcoin, does security matter to you? Does the failover mechanisms matter to you? Do my incident response systems are they important for you? Those usually get floated over and not really the priorities. They'll come to me and say okay, what is your APR? What's your reward rate versus provider A, B, C, or D, right? And in the recent years, right, that I'm seeing is that as we shift. As we see more adoption of institutions, banks, right, ETFs, DATs, and listed institutions, the risk and compliance frameworks got even stricter. And add on to that, right, that there are additional hacking incidents that happen in the industry, where we see major losses coming out from certain staking providers, and API compromises. We see forceful withdrawals of Ethereum from the validators. So things like that happen, which kind of put security architecture to become at the forefront, right? And instead of us going out to those investors and saying, do you care about security? Now they come to us and say, we care about safety and security. We care about custody. We care about how, where the assets are being held at, right? What we see is that, investors now, they want to look at you at whether you have the best custody, the best in class custody, whether it's safe, whether assets are being stored at a qualified custodian, for example, and whether it's being staked to a reliable staking provider. As I think, the shift is as simple as that.
Yeah, the expectation evolvement makes sense, and curious to see how it will continue to evolve moving forward. Beyond the on-chain opportunity, the market's matured to a point where regulated option strategies can now drive high single-digit yields without any of the actual blockchain risk. Curious to hear your guys' view on that trade-off, generating yield off-chain via derivatives versus taking the native on-chain route. And Joseph, let's start with you for this one.
So I think it's going to be all of the above, meaning, there's a lot of talk right now about the amount of ETH in the ecosystem being staked, and like any other financial yield product, the more demand there is, often the yield comes down, and people are worried, should we be doing derivative things? The general staking yield will go up or down. It doesn't matter. It's just the hurdle rate that I need to beat to generate alpha. So if the staking rate goes to 3%, great. If it goes down to 2.5%, I think you're going to start seeing people allocate across many different strategies to generate yield if they have permanent capital. It could be staking, it could be restaking, it could be liquid staking, it could be derivative, although the derivative market means you are taking, by definition, counterparty risks. It's not risk-free. And then you're going to start seeing long-term capital become liquidity provisioning providers. And what do I mean by that? You referenced there are new insurance companies to insure Bitcoin, to insure slashing risk. It turns out they're not insuring in dollar terms. They're insuring in token terms, which means they need to give someone back ETH or Bitcoin. Where are they going to get that from? They're going to get it from DATs who can supply liquidity to insurance pools. You're seeing prediction markets explode. The dirty little secret of prediction markets is it takes two things: tens of millions of dollars of cash flow to buy marketing and distribution. You see what Kalshi and Polymarket are paying. And the second thing is they need tons of stable coins or ETH or Bitcoin or some exposure to actually provide liquidity and prime to many, many fragmented bets. So you're going to start seeing people who are not looking for VC-like returns. I don't want a convex outcome one way or another. What I want to be able to generate is, in like US baseball terms, singles and doubles reliably. And if you have permanent ETH capital, you can be the most efficient liquidity provisioner in many different ecosystems. So I think it'll come from staking, it'll come from option strategies, and we're going to end up becoming the liquidity provisioning provider to industries that are starved for long-term capital, because crypto does not have long-term capital looking for singles or double. They have long-term capital that want really convex outcomes. That's not what we're looking for.
Great. Well, we've spent this session talking about yield, but zooming out for a second and to close things out in the interest of time, what's the one question you all are tired of hearing from skeptics, and what's the final answer you'd give today so that you never have to answer that question again?
Okay, well, maybe I'll start. So I always hear, right, as a staking provider that, why are some of the networks that you provide for, why is the staking reward so low, right, for certain networks, right? The key here is that, staking itself, when you're doing native protocol staking, right, you're not just earning that APR the headline APR that you see, right, be it on the UI or the dashboard, whichever, right? When you are doing native protocol staking, you're actually providing economic collateral to the network. You're adding value to the underlying network. So in essence, what you're doing is you're earning two things. Number one, you're earning that APR that you see, which is 3% or 6%, whatever that is. And number two, you're actually providing direct value, right, to the underlying Ethereum or Solana or Bitcoin ecosystem. And you are ensuring the viability, the security of the network, which in itself pushes up the first part of your yield generating mechanism, which is that 3%, 6%, because that whatever percentage number that you see in the first part of the yield mechanism, that is actually earned in terms of the underlying token. It's not earned in fiat. It's not earned in dollars or euros or whatever. It's earned in Ethereum or Solana or Bitcoin, right? So in essence, if we can understand that part, then in a way, that is providing value to the investor in two segments. Yeah.
I go next? Okay. Yeah. One question I have been almost asked every day is safe yield for Bitcoin possible? Yeah. The answer is yes. It is possible to allow Bitcoin to generate yield in a trustless, non-custodial, and yeah, Bitcoin does not leave your title away. Yeah. So Bitcoin, the Bitcoin chain and Bitcoin, the asset is not as, okay, the Bitcoin chain is not as dumb and non-programmable as many people think. It is indeed, to some extent, programmable, which is enough to allow Bitcoin to be as productive in a safe way as how ETH is productive. Yeah.
I am so lucky I get to travel to conferences. I see a lot of the same faces. Every time I go to a conference, we go from DAT 1.0, then they're asking me questions about DAT 2.0. Now, like, we're 7 months old, and I'm being asked questions about we're in DAT 6.0. No, we're not. We're a young business. We are a great allocation vehicle. We are permanent capital. And I would tell you, in the 7 months, we've gone from formation and original accumulation. There's very few DATs who formed correctly, kept a clean balance sheet, and been able to actually get exit velocity, which means you own billions of dollars of capital and you have a clean balance sheet. They also get the question of, like, will you survive a downturn? Oh my God, I'm 7 years into crypto. There's been at least 5 downturns that were as bad as this. The trick is to pick great partners, have a strategy, and do the right thing every day. My previous life, I was at BlackRock. We picked exceptional partners in Coinbase, in Securitize. We built long-standing, durable relationships. It didn't matter if crypto was up or down. You do the right thing, you stay focused, and you'll do incredible things in the long run. There is so much FUD and disillusionment in this industry. The level of prosperity and the level of change we're going to create, not only in finance and society, is going to blow people away. Stay positive, take a deep breath, find great partners, and just do the right thing. And in the long run, it's funny, you come to these conferences, and when things are going up, everyone's drinking. And when things are going down, everyone's drinking. Like, take a deep breath. We're in it for the long run, and we can do incredible things for society. And that's what we're doing.
Well, this was an excellent session. Thank you, Yanshan, Joseph, and Fisher, and thank you to all of you in the audience as well.